question of taxation touches every home in America.
Cutting through the static of the tax world, it's Simply Tax. Brought to you by BKD CPAs and Advisors. Everyone needs a trusted advisor. Who's yours? Now here's your host, Damian Martin.
Hello and welcome to our first episode of Simply Tax for 2021. It's a new year, and actually just like last year, we have new tax-related legislation to unpack. The Consolidated Appropriations Act 2021 was signed into law on December 27, 2020, and contains, among other things, a fourth phase of legislative COVID-19 related relief that we've been anticipating pretty much since the enactment of the CARES Act at the end of March of last year. To help you cut through the static of these latest developments, we've consolidated the takeaways that you need to know into a 2-episode look at the CAA 2021. Today, we'll kick things off by unpacking the provisions related to the Paycheck Protection Program that made changes to the program and created a second bite at the apple for certain borrowers. I found it helpful to think of these provisions as falling into two buckets. First, changes to the overall program that apply both to the first round and the new second draw loans. And second, new requirements that only apply to those second draw loans. In the first bucket, the new legislation clarifies expenses paid with forgiven PPP loan proceeds are fully deductible. Wait, did you just say fully deductible, Damian? I sure did, Damian. Forgiven PPP loans are now truly tax-free, free money. Wow, that's great, Damian. What else is in there in terms of overall changes? I thought you'd never ask. The CAA 2021 also permits 4 additional eligible non-payroll uses of PPP proceeds, allows for the selection of the covered period for those needing more than 8 but less than the full 24 weeks, simplifies the loan forgiveness application for any loan up to $150,000, and expands eligibility for PPP loans to include most Section 501c6 organizations as well as housing cooperatives, newspapers, broadcasters, and radio stations. In the second bucket, the new law also provides a second round of PPP loans targeted at hard-hit businesses that generally employ 300 or fewer employees and can show a 25% decline in gross receipts in any quarter of 2020 as compared to the corresponding quarter in 2019, or a 25% or greater reduction in the annual receipts in 2020 compared to 2019. Now last week, late on the evening of January 6, 2021, the SBA and Treasury released 2 new interim final rules containing guidance on both first-time and second-draw PPP loans. Then, in keeping with the typical Friday night, late-night trend that we've almost come to anticipate now, the SBA released new summaries of the first and second-draw loans, along with the new borrower and lender applications for second-draw loans after announcing earlier in the day that the program will reopen today, January 11, 2021. Overall, I'd say the highly anticipated guidance and new applications didn't contain any huge surprises. However, it did provide some much-needed and generally borrower-favorable clarifications. That said, there's certainly a lot to unpack here, and that's why I'm excited to share with you on the podcast today a conversation I had with returning guests James Anderson and Tad Goodenbour. James, Tad, and I held a webinar on December 28, 2021, along with frequent podcast guest Jesse Palmer, where we took a deeper dive on the provisions of the CAA 2021. To include the Paycheck Protection Program. And we've included a link to the archive of this webinar along with other helpful articles and resources in the show notes of this episode so you can learn more and check out the slides in the presentation. All right, that's enough for me, especially since I've been talking to myself already here today. Let's jump in, starting with 2 questions that I'm getting a lot right now. Who needs to be taking a look at this, and what approach should they take? Take it away, Tad.
Honestly, I think that everybody needs to be taking a look at this. I know that I've had some conversations with clients and prospects that, we're doing okay, we're doing fine. But, a couple of these things have nothing to do with doing okay, doing fine, like the retention credits, okay? This has been a big deal that has come up with a lot of our clients because it wasn't on the radar before because everybody who got a PPP loan, was not eligible for that. But now, you can't double dip, and that's part of what somebody's going to have to look at is what's more valuable to me, getting a retention credit if I qualify for that, or going back in and getting a second round on or a second draw PPP loan. And part of that evaluation, I think, is going to be what is my administrative headache, for each one of these things. I get a PPP loan, I've got to go through all of this, gyration that, we went through the first time, the brain damage. Am I going to be able to spend it all? Or do I take the path of least resistance? I look, if you're eligible for the second round PPP, you're probably going to be eligible for the revenue reduction, the retention credit. If not that, maybe the partial suspension or full suspension. Is that going to be simpler for me? And because that's a fairly lucrative credit that's out there. So I think you really have to run the numbers because, again, if you use the wages for one, you can't use the wages for the other. So there is a bit of one or the other and not both. But so I just think you have to sit down and do the evaluation as to which one is easiest and most beneficial to you.
Very interesting how they fit together. I don't know, James, anything you'd add to that? And because I think that I would absolutely agree, Tad, and I think that's definitely something everyone needs to do. But I feel like they're still kind of their heads are swirling a little bit about how to do that and how to approach it. So, James, I don't know from your perspective, anything you kind of add or agree with there?
Well, it seems like when the bill was signed, one of the questions that right away people were asking was, how do I determine whether I really had this 25% drop in revenue or not? And I think what we understood at the time, just based on the language of the statute, was, look at each quarter and let's see how it comes out. But we didn't really know how the SBA was going to define what are gross receipts. And, with the guidance we received now, we have a little bit more to go off of, which basically I think is the SBA's previous definitions. If you look in their code, basically says it's, kind of what you use for tax return purposes. And you don't have to include, things like capital gains and things of that nature. But one thing that is very common sense that I just don't believe we had the answer to a week ago was, what if I had a loan forgiven, my round one loan, does that count against me for purposes of gross receipts? And, fortunately we got that answer. So I think when, your question is, hey, I had my round one loan, I've already spent the money. What do I do now? I think the first thing is if you did have a reduction in revenue, you need to start drilling into, am I going to qualify for this 25% reduction? Because there's several different ways you can get there. You can get there by just simply looking at an annual basis based on tax returns, right? So that was one very kind of simplifying convention. But then you also have the ability to go, there were a lot of businesses that in the second quarter of the year, were not earning revenue at the same rate that they're used to in 2020. And so just starting to figure out how to go back and dig in to see, do I even qualify? I think is really the things that people should be doing now, because pretty soon here, they're going to open up the portal and there's going to be a mad dash again for dollars. And just having done that homework before that happens, I think would benefit everybody.
As I mentioned at the start of the episode, the program reopened today, January 11. However, to promote access to capital, initially only community financial institutions will be able to make first and then second draw loans, with the PPP opening to all participating lenders shortly thereafter. Last week, the Consumer Bankers Association, which represents large lenders, indicated they expect to be able to offer PPP loans starting the week of January 18, 2021.
To piggyback on that a bit, James, all of us are looking for an easy button, on some of this stuff. And a couple of things that came out related to the second draw loans. One, what you said, James, is that to test the reduction, you can, if you had an annual revenue reduction, you can just look at the tax returns. Now, if you have any clients call you and say, look, can I get my tax return done tomorrow, for 2020? Yeah. But it's kind of like the Schedule C thing we had last year a little bit. But
right.
So, you've got that item. But the other thing that was beneficial that came out is the documentation for applying for this loan. I mean, if you use 2019 payroll to determine what your loan amount is, if you used it for your first loan, you use it for second loan, you use the same lender, you don't have to submit anything to them. They have the information already. So that was big. So, if you're going to go back in for a second loan, if you can use the same lender, that would be great, because it's going to really reduce the amount of work you're going to have to do as far as documentation. And if your loan's under 150, it's even better because you don't have to document your 25% reduction at that point in time. You just have to certify that you had it. So the PPP loan that, a lot of that work is done is part of your evaluation. I still think that it's really important that you take a look at the retention credit, because we've been kind of having some calls with clients, and they are just, their jaw is dropping when they actually run through the numbers in their head, and their comments. I don't know if you get this one, James, but the comments I've been getting back are, so you're telling me that the government will subsidize 70% of the first $10,000 of my employee's payroll every quarter? I said, yeah.
Yeah, and I think the thing that they often overlook that is important though is you do have to meet one of these two tests
Right.
to qualify for the ERC in the first place, which is right. I had to have had some sort of a suspension of business caused by, the government telling me I could not operate, or, I did have to have a 50% drop in revenue, right? So
Or 20%, for this year. So
that's right. That's right.
And so that's kind of the neat thing is that so if you got the 25%, to meet the PPP2 second draw loan, you can pretty well be comfortable that you're going to be eligible for, at least from that perspective, for a time period anyway, for the ERC.
Yeah. And so I do think there is a planning opportunity here for people that think of your businesses that were highly impacted by this, right? So you got your restaurants and bars, your gyms, salons, dental offices, things of that nature. And let's say they had their round one loan, but for some reason they just hadn't gone in and filled out the forgiveness paperwork yet, right? And we've talked about this before, but if for loans that are already forgiven, this is passed, right? This doesn't apply. But if I haven't applied for forgiveness yet, and I know that I would qualify for the ERC at the same time, I need to make sure now, before I submit my forgiveness application for my round one loan, that I am maximizing the 40% non-payroll costs on my application. And, just for listeners, I think it'd be helpful to kind of dig in a little bit and say, when everybody got these loans back in March and April, you were getting 2.5 months of payroll and you had to use it within 8 weeks. And so it was going to be really hard to use only payroll costs to get that loan forgiven in full. But then, of course, now that there has been such an expansion in the covered period all the way up to 24 weeks, if you so choose, I think a lot of people were saying, oh, I can make this really easy on my forgiveness application just by using wages only and not even having to worry about gathering all this data on my non-payroll costs. But I think now, if I want to go after the ERC in addition to my PPP loan, especially if I'm going to go get a round two loan, I want to try and minimize the amount of my wages that I'm using on my forgiveness applications. And I want to maximize the 40% non-payroll costs, which of course now includes some other new things that weren't there before. I really want to maximize those on my forgiveness application, because once I put a wage number down on that forgiveness application, that wage is not to be used for calculating the ERC. And so and again, this is, I think, one that this really surprised me. We can get ERC if we are a PPP borrower. And so I do think it's going to cause some differences in how folks, not necessarily how they operate, but it completely impacts how they will fill out their forgiveness applications.
Compounding that, and we see a list of all the questions that the webinar attendees ask, and it was a common theme in there about people said, well, look, I filed my forgiveness application already, and they did exactly what we said. So say somebody had a $500,000 loan, and for the 24-week cover period, they had, $1.4 million of payroll. Well, they listed the whole $1.4 million of payroll for the 24 weeks on their forgiveness application. The loan's forgiven. So the question comes back to us and says, well, since my payroll is so much higher than my loan amount, can I still use some of that? Well, I mean, there is no question there. And I guess sometimes in the lack of clarity in the rules and regulations are opportunities. And I guess the way I would look at that, and I have nothing to go on in this other than a little common sense, is that, the first dollars you spend are the first dollars forgiven. So, if you spend $500,000, now you're not going to be able to use a 60/40 because, you didn't have those on the non-payroll costs on your application. But I think any payroll costs that are on that 3508 that are in excess of your loan amount, or if you have a FTE reduction, take that into consideration as well. But I think any ones that are in excess of that, I don't think were you can actually say that PPP funds were used.
Yeah, I think
on
that's
that.
a practical approach, right? In your case, you would say once I get over $500,000, I may have listed them on the application,
Yep.
but only 500,000 was utilized against my loan forgiveness.
Yeah,
So,
and that's somewhat validated by the fact that they now have the name your covered period. That, hey, look, if I had to name my covered period, before I filed my 3508, I would have only shown whatever I needed to get it fully forgiven. So, like I said, you and I a lot of times deal with practicality, but sometimes that can get you in trouble as well. But I think this one is really a no-brainer on the standpoint of I would do that, and if they come back later and tell me that I couldn't do it, well, we'll deal with it at that time. But I think that's a practical answer.
What's the strategy there, or what strategies would you expect to see? Because I feel like it's going to be a little bit based off of how your wages did come into play, and again, to answer some of those practical assumptions. But anything you're seeing or sensing at this point in time in terms of how to best maybe go about getting the best of the benefits that are available out there?
yeah, well, I think Tad brought one up a little earlier, which was a huge simplifying convention. You can tell in this that in these rules, and especially in the rules that came out last night, that there is a tilt toward trying to make this easier on small companies to comply with, vis-a-vis the being able to use an annual calculation of revenue from tax returns rather than I think there's a mention within the documents that say, we realize that a lot of small businesses probably don't have the same ability to go in and run quarterly financial statements like a larger company would. And so they've made some of this stuff easier. And so you kind of pare all that back. And I think the most complicated ones right now are going to be people that did not fully utilize their round one, right? For the folks that did fully utilize their round one, as you mentioned, if I'm going to use the same lender and I had enough wages in 2019 to go, I can basically, if I had a drop in revenue, I can basically just use my 2019 wages again and very simply go in and receive that second round loan. So, I mean, for the smaller companies, I think that's going to be a really big benefit, especially if they've already expended the funds on round one. I just think the complicated ones are not for the people that haven't expended the round one funds, but the ones that, for whatever reason, didn't fully utilize the loan that they had, because there's a very short window here to try and capture all the benefits.
I'm running up the white flag, James. I don't know, about you, but on the second draw loans where it says you have spent or will spend, that doesn't then imply to me that you have to spend it in the 24-week time period. So in essence, you're not going to get your full first loan forgiven, and that's apparently okay as long as you can show you spent the money.
Yeah, but I think, didn't they add some language that says you cannot get your second draw loan until you have spent the first loan proceeds entirely?
Well, I get that. And that's not I guess my concern about spend. My concern is that, it's not saying that you have to spend it in the 24-week time period.
Right.
So to me, what it's really saying is that you don't have to have your loan forgiven in full to qualify for a second loan. You just have to show that you spent the money on qualified expenses.
True. But I think the practical application is that I was thinking of is, let's say you had somebody that either applied for the round one really late, or for whatever reason, they either applied and gave back some of the funds, or, decided, they got, let's say their loan, I mean, we have a couple like this. Let's say that your loan was, $1.8 million. And when all of the uncertainty was going around about the need certification, and so you had some people that got scared and said, you know what, I don't want to mess around with this. I'm just going to return this loan. Okay. Well, now they get a second bite at the apple. But if they do that, there's no practical way that they're going to be able to get a round two loan, because they won't be able to spend those funds before March 31.
Yeah, I think count 24 weeks. That's what, no way. Well, they could, they might be able to, but the practical one that I'm running into, I've got, a guy with, they have like 40 hotels, all in, different LLCs. And so they got round one loans for him, but they couldn't spend them because in the 24 weeks, because they were shut down. Okay. So now this unless you read it literally, like, I think I'm reading it now, they couldn't get a round two loan.
because they haven't spent the money yet.
Unless you say, no, they just have to spend that money. It doesn't say it, they have to spend it in the 24-week time period. That seems to me to be the right answer, because that's the kind of business they're trying to help with this.
Yeah, so it just won't be a forgivable loan.
The first one won't.
Right.
The second one they'll probably be able to spend, but again, I my initial thought was that no, that you had to have spent the money in the 24-week covered period of your first loan.
Yeah.
But I guess now I'm not. They've had, like they said, 3 chances to clarify that. But when they said spend or will spend, now the will spend, I guess could go back to somebody who, like a C8 or a C6 that takes one out now.
Yeah.
And they actually get it spent within a really short period of time. They could go get a new a second one because they've spent it. But
Correct.
I think that's real narrow acceptance. So I guess I surrendered on that one.
Yeah, and I think where my point was going at it was I kept thinking there might be some people that can go in and get 2 loans right now. And I think the chances of that really happening are very small, because by the time you actually get this first loan funded, it's probably not going to be before January 15th, right? And so now you've basically got 10 weeks to spend that money before you can get your round 2 loan funded. March 31 is only 10 weeks off of there. And so I think originally my view was that there was a planning opportunity maybe for people that shied away from it because of all of the negative media, who really did need it, but just didn't want to mess with it because of the negative connotations, who now get a second chance at this. But I think if they do that, they're not going to be able to get both rounds. They might be able to go get round 1 now and use that money, but I don't think that there's an opportunity for people now to go get round 1 and round 2. It's very unlikely that you would get that, be able to spend all the money that quickly,
Right.
and still have time to get your round 2 loan funded before March 31st.
Yeah, I think, like I said, that do-over provision, for the people who got, scared off by the Mnuchin rant, again, I don't think they're probably all that concerned about a $2 million loan, because maybe they didn't have the 25% reduction, but if they can go back and get the other one where they don't have that reduction, that they have to have.
Yeah. The thing that will be interesting right now is there's people out there, right, that had loans that were just barely over 2 million that got scared about the whole environment of loans over $2 million, that now have a decision to make. Do I go back and re-up my round 1 loan?
Yeah, no, I agree. What are your thoughts on that, James?
I think what we need to be doing is having conversations with people so they understand it's an opportunity, but they also need to understand, to me, one of the things that might be harmful in that approach is you have this need certification, and then on top of it, if your loan's over $2 million, you have this questionnaire that you have to fill out that tells the SBA all the things that were so important for me to get this loan. But now I'm basically making an argument, well, I kind of got through without it, but because the program is extended now, I'm going to go take another crack. And I think if you take that approach, what you really have to be able to argue is, look, there was so much uncertainty going on at the time about how bad was it going to be in the public eye of this $2 million. I needed the money, but I didn't want to deal with the backlash, so I just gave it back.
Yeah, that'll be interesting to see too if they look at those differently with that in mind,
Right.
But I mean, I guess it will also be interesting to see too, because I mean, we know that the same certifications apply now, right? For round 2, and you still have to have that uncertainty. But I guess maybe perhaps if the fact that you meet in the decline in the gross receipts, that maybe makes it a little more straightforward. I don't know what you think.
Yeah, but remember that the certification is at the time of the application. So if this is a new application for you, you have a whole different set of facts in front of you.
Yeah, I do think Damien makes a good point, though. On these round 2 loans, there might already be some preemptive attack against the uncertainty provisions because you don't qualify unless you had a significant revenue decline in the first place.
Yeah, but remember as well, too, is that if your first loan was over $2 million and hasn't been, quote, resolved yet, you aren't going to get the money until they resolve your first round.
Yeah, and to me what that means, Tad, is I've already gone in to seek forgiveness. The bank has done their portion. It's at the SBA, but the SBA has not completed their review. Is that how you're looking at it?
I got the kind of feel that it was maybe a little further than that, meaning that just because they hadn't reviewed it No, I guess that was on the second piece of it. It said that or otherwise feel that they didn't qualify. No,
Yeah.
I agree. If
Yeah.
they hadn't done that,
So then it's interesting because I think you made a comment, Tad, that really most of the loans that were over $2 million that had been in some sort of a review process really have not gotten that far through it. And that wasn't there an outside group that was kind of outsourced by the SBA. And now, so there might be some of those that are hung up in that might prevent a round two loan. The one surprising thing to kind of shift gears a little bit, this whole new method for farmers and ranchers that's in the bill. A lot of our farmers and ranchers that file a Schedule F maybe weren't able to receive a round one loan because they didn't have a net profit on their 2019, Schedule F. And I think now with the clarity, you understand for somebody that doesn't have employees, I can simply use my gross revenue from my Schedule F. So that would entitle you up to a $20,000 loan roughly. So, the question I would have in there, I have two. One is this new method that they allowed doesn't apply to Schedule C taxpayers. So you could almost draw kind of a line between those two, and a Schedule C taxpayer still has to base it off of their net profit instead of their gross revenue. But on the farmers and ranchers, one of the requirements of receiving a round two loan is that you have to have fully exhausted the funds of your round one loan. Tad, what are your thoughts on if I'm a farmer and rancher and I previously wasn't eligible for a round one loan, but now I am, because I'm not actually expending those funds because it's not based on money I'm spending, it's based on my gross revenue. Would I be able to go get a round two loan if I'm a farmer and rancher at the same time I get a round one loan?
I would probably say yes, and I'm gonna rely on the owner compensation replacement rule, that they had in there initially, that basically a Schedule C, which I kind of equate an F with a C in that regard, is there was no spending requirement. I mean, it was strictly if you had no employees, the assumption was that you spent that money without any other documentation. So I think that I would probably assume that the Schedule F guys are in that same boat if they had no employees.
Right.
And so I would think that they could go back and apply for a PPP2 loan under the same provisions and get another $20,833.
Yeah, another one that I think comes to mind, and we haven't talked about this much, but of course the bill that passed on the 27th provides a new form of grants for shuttered venue operators. And we haven't talked about that much, but one of the requirements of receiving one of these shuttered venue grants is if you take it, you're not eligible for PPP. So, one of the questions that we've already received, and this is a difficult one, I think, because under the shuttered grant rules, the amount that you can actually qualify for if you've met the declines in revenue and so forth, is you can actually receive up to 45% of the gross revenue that you had in 2019. That amount will likely be significantly larger than 2.5 months of payroll, right? So that grant could be significantly larger than PPP, but you can't get both of them. And so the question that I really have right now is, number one, if you look at who's eligible, there will be some entities, for instance, you might have a local semi-professional sports franchise. Is that considered a live venue, live performing arts, right? Sometimes I think we're thinking of places like concert halls and arenas and things. What about local sports franchises that otherwise meet the requirements? So the first question is, I think we're going to have some things on the fringes of what really qualifies. We don't have those rules yet like we do for some of the PPP rules we got last night. But I think the larger question is, I have to decide which one of these I'm going to go after. And I know that the PPP is going to open up here really soon. We don't have any rules right now for shuttered venue, and we don't know when that's going to open up. And there's a limited amount of funding on the shuttered venue operators, and it's even geared more towards the most severe revenue declines in the early stages of the funding. There's a chance that by the time my shuttered venue qualifies to go get funding, that's after March 31. It could be. And if it is, I've now lost the ability to go get a PPP loan, and I may not have the funding left or may not qualify for the shuttered venue. And so I think that's something that that people that are looking at the Shuttered Venue Operators Grant really need to examine and say, the PPP has more certainty to it, even though it might be significantly less in terms of dollars.
I mean, like, two comments, on that thing related to the shuttered venues. The first is, the revenue reductions, on that they have a 3-tier system about, who gets to, go to the window first. Tier 1 is if you have a 90% or greater reduction in your gross receipts, 2020 to 2019, you're number one in line. So you got 14 days. The first 14 days are yours. And then the next 14 days are anybody that has a 70% or greater decline, in the revenue. So number one, do the calculation first. If you're looking at, do I do one or do I do the other? Look at the calculation first. Don't just assume that, because you maybe meet the definition of, being eligible for one of these grants, that you're going to get there, because your revenue reduction has to be pretty substantial to pony up in line. So let's say you decide to go and look at the PPP2 loan, depending on what your wages were back in 2019, it's like James was saying, maybe a much smaller amount, but you got the certainty. One thing I did want to point out there, and it's a very subtle piece of the qualification requirements, is that it said that if you're getting a shuttered venue grant, that you can't get a PPP loan subsequent to the date of enactment of the bill. So you could have gotten a PPP1 loan, okay, and get a shuttered venue grant, but you can't get a PPP loan subsequent to the date of enactment, which I think is December 27th. I think was the enactment date.
Right.
So, but again, that you're right. That's a fine line. If they don't roll that program out until late, you're kind of boxed into a corner.
Looking at the requirements for round 2, obviously, we also know that the 500 that we had before is now 300, generally speaking, and maybe that comes into your equation. If you don't qualify for PPP, then obviously that makes it easier from a shuttered venue perspective.
Yeah, let me talk about that 300 for a minute, because there's a real subtle benefit that I think happened here when the calendar flipped. When you look at these 300 or the 500 employee qualification under the SBA rules, it is based upon the prior calendar year. Okay, so we're in 2020 or 2021 right now. Okay, so what ends up happening is that now, to determine whether you had 300 employees, you're looking at 2020, and if you were kind of shuttered, your employee count may be down anyway. So again, it's a different count, and the way that's done is, you take a look at all your payrolls that you had in 2020, and you take head count, because this is head count 300. It's full-time, part-time, and you get an average of those for all your payrolls during 2020. So that's a subtle distinction. So don't, because it went down to 300 and maybe you were at 500 back in 2019, one shouldn't assume that they're not going to meet the 300. Okay, because if you had to shut down or whatever, you could very easily be under the 300.
Yeah, that's a great point. And I know too, and then you see, going back to round 1 and kind of figuring out the employees and what the thresholds were, you can talk about some of the, I know SBA has some rules as well that kind of come into how you're counting, and not necessarily how you're counting, like you said, you kind of talked to that, but what number you're targeting and who qualifies. And is that any different between round 1 and round 2?
I'm not sure I'm following the question. If you're talking about, the affiliates and that type of thing.
Affiliate rule, because I feel like there's still a lot of questions that people have from round 1. Yeah.
I think the rules that came out last night in that IFR, and James, commented on it forward too, is that they're trying to simplify it. It was pretty much said in there that, it's the same qualifications, except use 300 instead of 500 employees. So if you got a Naxos code 72, you can still do the more than one location. Okay. Now you got to be careful. They've put back the corporate group limitation in here, which that one kind of went by under the radar a bit. But in PPP1, a corporate group could only get a total of $20 million of loans. Corporate group really wasn't defined all that well. If they really mean corporate, or does that mean LLCs? But I think the general consensus is people are saying, well, they said corporate, so if I'm not a corporation, this thing doesn't apply. But What happened is in the round two, they brought that back, and you have an overall limit of 4 million, even though the loan amounts are 2 million that you can get. And like I said, if you have, multiple legal entities, then each one of those in the Naxos Code 72 can get a $2 million loan, but you've got to watch out for that $4 million exception. But the rules are the same, other than, you cut down 500 to 300. I think they actually threw another class of the radio stations or newspapers or something, I think was in there as well. But and the other thing, the affiliation, the same groups that didn't have to affiliate under PPP 1 don't have to affiliate under PPP 2.
Yeah, so one thing that's interesting on that employee headcount, and I suppose it's the same for the 500 or the 300 rule that maybe I have some questions about, maybe it's already answered, is there's some discussion in the IFR that if that 300 is on a per location basis, but I think in the rules it talks about how each one of those have to be a separate legal entity. And so, Tad, would you then say, let's say I own a group of sandwich shops, as long as in that entity I don't have 300 employees, I qualify?
I think it's a per location, as long as each location doesn't have, and each location is a separate legal entity underneath it, or are you saying that the locations are all within one legal entity?
Yeah, I mean, if I've got a group of sandwich shops and it's all in one LLC, okay, and I add them all up, and all of a sudden now I've got 400 employees because I've got 20 stores or whatever.
Yes,
I don't qualify.
I think that's correct because they're not in the separate legal entities. I believe that is correct because they did actually have that example in there, I think.
Yeah, but if I had operated those as, let's say, 4 different legal entities that were split up by what state the stores were in, for instance, even though I have 400 employees, if I divide that by my 3 entities, now I'm probably below 300 on each one. Now I qualify, right? So if I'm more of a holding company that has operations all over the place, even if I'm in class 72, that might prevent me from receiving a round 2 loan. Whereas if I had split them into separate entities, there's a chance I would have qualified.
Right. I think that's correct.
Okay. So the natural question that somebody will ask is, can I split them up now before I go apply?
I think the answer is probably going to be no. I mean, the fallback I have on that all the time is, got to be there at February 15th of 2020.
Yeah.
Which that's another point. I've had a lot of people come to me now and say, well, look, how do I calculate my employees if I wasn't in operation, or my loan amount if I wasn't in operation back in 2019? I go, well, when did you start? And they give me some date like July of 2020. and I said, well, you aren't going to qualify. They said, well, I didn't get a round 1 loan or yet. And I said, well, you still have the rule that had to have been in operation on February 15th of 20 in order to qualify. So.
Yeah, I think that's a great point. If you are a brand new business that's on opportunity this summer as a startup, I'm not sure that you're going to qualify for a round 2 loan.
Or a round 1.
Or a round 1 loan. Yeah, great point.
Yeah, and maybe a question there. So and again, maybe you're going to go back to this, everything that applied in round 1 applies in round 2, but the situation where maybe you did an asset acquisition, so new entity, taking that approach, do you think, as I know FAQ kind of gave an opportunity there for round 1. What are your thoughts on that?
Are you talking about I have an existing entity that wasn't existent at February 15th that went out and got a new one?
Right.
I don't think you're going to be able to, because if I already got one, for my existing entity and I did an asset acquisition, that doesn't, entitle me for any other kind of deal. Now, I mean, that kind of leads into another area that, acquisitions and dispositions, have an effect, and that's on your 25% reduction. So what happens if in 2020 I did an acquisition of another entity, okay, and I brought it into my fold? Well, crud, if I don't make any kind of adjustment whatsoever, for the revenue from that new entity coming in, I'm comparing apples to oranges. On this thing. So I may blow my 25%. Well, they gave you a bit of a carve out on this. I mean, it's a little bit convoluted how they did it, but they basically said that if you acquire an affiliate, then you can take the gross receipts of that affiliate into account for all periods in your measurement. So I don't know how you're going to get it, but you could go back to 2019, for that new affiliate that you brought in and get their revenue back then to do the testing for the 25% or more. But the troubling part is that they have something in here called a segregated division. And they said, however, if you acquire a segregated division from somebody else, that you only count the revenue from that segregated division going forward. So to me, a segregated division means I did an asset acquisition. Okay, and so I acquired the assets of some other company or division or a trade or business from them, and all of a sudden now my revenues would have went up in 2020, but I don't get to adjust my 2019 revenue. I mean, that's the way this thing actually reads. So that one, I guess, troubles me a little bit, and I'm hoping, that if I go back and read it again, I may come up with some different answer. But it was pretty short and succinct. And James, I don't know if you saw that one in there, what your thoughts were, but that one bothered me.
No, I agree, and I think there's some uncertainty there. I really do.
So I guess speaking of that and kind of where we are, and maybe kind of bringing everything full circle, I mean, what are the questions? What are you looking for? And, what are you kind of unpacking, especially, or I guess maybe hoping to unpack, and maybe some of the future guidance that we'll get? Maybe James, we'll start with you on that one.
The question right now is, right, what things do we not know based on what we received? And again, I think some of the largest uncertainty for me surrounds not knowing the rules to this shuttered venue piece and how the interplay with PPP is. As Tad mentioned a little bit earlier, I still think there's some kind of the whole gross receipts. I mean, it seems pretty certain, but there could be some items in there that could use a little bit more guidance, for folks that are applying for round 2 loans. And then to me, again, just I think we know the answer now with respect to people having to go in and actually having expended the funds on round 1 before they can get round 2. But just given the amount of time that exists here, it seems like the intent was to give people a chance to re-up on their round 1 and still provide a round 2. But I think it's very impractical that you'd be able to do both of those at this point. And so as we move forward here, I would be interested in some guidance that would say, okay, I went in and re-upped my round 1. I'm going to spend it, but can we get some sort of a safe harbor or a grace period on having every single dollar spent before we can get a round 2 loan? Those are probably the main ones for me.
Tad, same question. How about for you? What's hanging you up?
I mean, we, all of us like to have, certainty in our lives and certainty in our rules and things, but I give them a little bit of credit, or actually quite a bit of credit here, because, they've given us through trial and error, maybe, on the round 1 stuff, but what they've given us here is a pretty decent roadmap to follow here for the round 2 loans. Yeah, I mean, I'd like to see a little more clarification on the item I just mentioned on the, any kind of an asset acquisition, and those type of things. And sometimes, not having all the guidance out there, you get a little bit of leeway in how maybe something is interpreted, and you can use that to your benefit. So, I mean, I don't know that I really would have a whole lot more. Look, if they've only got a certain amount of time to spend on issuing IFRs, I think we're good with what we have here. Move on to the next thing, like James says, the shuttered, venues or something like that. Now, I do think, okay, that the biggest thing that needs to be done from a potential borrower standpoint is evaluate the retention credits, as well, because I think that's something that was, I'm not going to say overlooked, because it wasn't available prior to this point in time. So I think that's a big thing. We have, James, I don't know about you, but I've had a number of calls, with clients and prospects and things, on that retention credit. So look at it. That's where, those rules kind of get a little bit more complicated, because those are really treasury rules. SBA has nothing to do with the retention credit. So you've got a lot more, not complicated, but, a little more involved rules to follow, especially when you get to the aggregation and the like. But rambling as I have just now, Damien, look, if this is all we're going to get, I'm okay with it.
Yeah, especially as fast as they got it out. So, yeah,
it's kind of, we talked about before that, they actually had a 10-day deadline, I think, to get some, some type of rules out. And, around 5 o'clock, the Twitter sphere was, they aren't going to do it. They're going to miss their deadline. And well, first of all, deadlines mean nothing to SBA, as we've seen, historically. But then those of us who have been around enough to know that, these guys work nights. So they met their deadline.
Yeah. And I think, don't know how much to go into this or not, but given that today, when we're recording this, is Thursday the 7th, and, yesterday might have been one of the craziest days in the history of our country, to see that the folks that when this got released, I mean, it was only 8 o'clock in your time zone, Tad, but it was, 10, 11 o'clock last night on the East Coast where this was likely happening. And just considering what was going on in Washington, D.C. yesterday and all through the night, it is a little bit amazing to me that they were able to get this pushed out last night, now that I think about it. Actually,
as you mentioned that, then, maybe they would have had it out by 3 or 4 in the afternoon had it not been for, the events in D.C. So, okay, they get a pass on that one. But I tell you, it sure does make late evenings or early mornings.
It sure does. That's one thing, I guess, if maybe we could compare and contrast or kind of mark up the differences between the two rounds. That's one consistency, the kind of the late night guidance drops here. So yeah, definitely more, I'm sure, to come. As we know, we'll need some more definitions, but this was enjoyable from my perspective, just kind of listening to you guys talk it through and work through some of the practical sides, because I think that's the thing that everyone is just so focused in on right now is the, what do I need to know? What do I need to do? And practically, what do I do about it? So thank you both. As always, I'm sure we'll have more opportunities to kind of continue to unpack this and as we continue to understand it more.
Appreciate it.
Yeah. Thanks, Damien. This is, it's hard to believe that when we did the first one of these, it was coming up almost on a year ago now. It's been interesting to continue to learn this area that, I think if you listen to some others around the country who talk about PPP and other things, I mean, this is not really solely an income tax issue that we're used to dealing with, right? So it's something that's allowed us to kind of dig into some things that are different than what we normally do. So it's been interesting. So thank you.
That's it for today, but we'll be back in your feed real soon with part 2 of our 2-part look at the PPP and tax-related provisions of the Consolidated Appropriations Act 2021. And I'm looking forward to breaking down the tax-related provisions, including more on the employee retention credit that James and Ted mentioned today, with BKD's Jesse Palmer and Yelena Bosovic. In the meantime, be sure to check out the show notes of this episode, available at bkd.com/simplytax for additional resources on the CAA 2021. Your feedback is very important to me, and I'd really appreciate hearing from you and knowing what you thought of this episode today. Please drop me an email at simplytax@bkd.com and leave a rating review on Apple Podcasts or wherever you get your podcasts. And if you haven't already, I'd also enjoy connecting with you on social media. You can find me out on Twitter, where I tweet about tax at Damian Martin CPA, on Instagram, where I post about my life at the intersection of tax and being a dad at TaxDad, on YouTube by subscribing to our Simply Tax YouTube channel, and out on LinkedIn. I'm Damian Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.